How is everybody doing today? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. I was trying to look a little bit more festive this week, as we got Thanksgiving coming up here in just a couple of days. This is, a little bit sweater action. This outfit comes complete with cat hair. So if anybody, if anybody's looking for wardrobe selections this week. So what we're talking about in our episode here today is what is the value of banks? What are some of the factors that determine the value of banks? I saw a great blog post recently from PCBB, and I wanted to bring this in real quick. So this is just called "How Much Is Your CFI Really Worth?" And the summary here says that basically sales data suggests a gap between buyers and seller price expectations in the M&A market. CFIs can maximize value by finding strategic business combinations that leverage both sides' strengths and minimize weaknesses. So let's take a look at kind of what's going on here. So let's start by looking at the M&A market. After a comparatively slow 2023, bank mergers and acquisitions have picked up a little bit in 2024. According to S&P Global IQ Pro, banks announced 93 M&A transactions through September 30th of 2024. All of 2023 saw 102 financial institutions change hands. So this year will likely conclude with a higher total. The same report said that aggregate deal volume reached $11.42 billion by September 30th, nearly triple the $4.2 billion for 2023. So far, 2024 has 3 deals worth $1 billion or more, compared with 1 each in 2022 and 2023. And the median price earnings multiple increased from 12.4 times in 2023 to 17.1 times in 2024. Those are all reasons for cautious optimism. Now it gives us a beautiful little chart here. And some of you, if you've been following the podcast for a little while now, know I've done a number of episodes on the M&A market, and I've covered a number of these articles from S&P Global. And this was one of the more recent ones. I actually covered the article that gave this chart here in it, but we'll take a quick look at it. So I would just say a couple things here. You can notice here at the top, number of deals. So you can see 2020, obviously COVID year, 120 deals, a little light. It kind of got back to what has been more normal for perhaps, say, the last 15 years, and that was like a 200 or 200 plus transactions a year. But then we dipped back down, 155 in 2022, 98 in 2023, 93 so far this year. I think we got about another 6 weeks left. Maybe we'll hit 100 before the end of the year. I mean, I think we'd have to have a little bit of a flurry of activity here before the end of the year. But, I'm sure we'll get at least a few more deal announcements. Will we hit 100 transactions for the year? Maybe. It'll be close. But the deal volume, or I should say the deal value is up. But I want to say from probably say like 2010 going up to 2020 for that 10-year period of time, it was pretty normal to have somewhere in the neighborhood of between 200 and 250 M&A deals a year in the banking business, as you just saw consolidation really take hold there over that 10-year period after the Great Recession in 08 and 09. You also, if you go back to 08, 09, you also had a large number of bank failures too, that kind of added to some of that consolidating number in the industry. But I'm just trying to give you guys a little context for kind of where the sales numbers have been out generally over the last, say, 14, 15 years. So then the blog post goes on to say, however, a disconnect remains between what sellers expect and what buyers are willing to pay. For instance, the median deal value to tangible common equity ratio dropped from 153.4 in 2022 to 124.5% in late 2023. Community financial institutions looking to sell can help close this gap by considering key factors in determining a fair price for their institution. Now, before we get into the factors, I just want to say something. The holy grail, if you will, if you're selling your bank, if you're a bank seller, the holy grail, if you will, is to get what's called 3 times book for your bank. Most of the time, most transactions, and this is what you see here, 153. So you could also think about that as 1.5 times book value. And now that's kind of dropped down to a little below that, kind of 1.25 times book value. That I would say that's kind of average. If you're below 1.5 times, Maybe there's something wrong with the bank, or maybe something happened there. They had to kind of cause you to kind of sell on the cheap, if you will. But generally, like if you see a bank that sells for like 2 to 2.5 times book value, they did a really good job. They got a pretty strong, solid number for their bank. It's very rare though, like I said, that you see those 3-time book value type transactions. But that's, like I said, that's like the holy grail. That's what every banker that is in the sales mode and looking to sell their bank, that's what they're striving to get. But like I said, most transactions generally fall in that 1.5 to 2 times book value. So anyway, again, just to try to give you a little bit more context on that. So, okay, so what are the factors that determine a CFI's value? So, of course, there are obvious factors that go into determining the value of an acquisition, such as the assets of both the buyer and the seller and how those assets fit together to make the combined entity greater than the sum of its parts. So, what are some of the things to look at here? Strategic considerations, economic context and market trends, accumulated and other comprehensive income, AOCI, and fair value adjustments. Now, that's basically, for those who don't know, that's basically a fancy way for basically saying the investments on a bank's balance sheet. So, in other words, their bonds, maybe treasuries, could be different type of bonds, could be like mortgage-backed securities, commercial mortgage-backed securities, treasuries, other type of government bonds, things of that nature. Let's see here, regulators. And then finally, golden parachutes and similar agreements. The other big thing, I like I said, we'll see if they mention it here. I'm not sure if they do or not, but the other big thing is contracts with vendors. Vendor contracts are huge, especially the core providers. But we'll come back to that in just a second. Let's go through these now a little bit more. So, strategic considerations. So previously, buyers might prioritize a larger customer base or geographic expansion and work out the integration details later. Today, banks look to acquire much more strategic, assessing long-term growth prospects and strategic fit. CFIs with compelling strategic alignment with potential buyers can improve their prices by presenting themselves as opportunities for true growth rather than just assets to be absorbed. Economic context and market trends. Overall economic conditions matter too, as does the health of the financial sector. Right now, net interest margins are likely to expand. Potential problems with asset quality are still possible, as are changes to the economy in the wake of this year's presidential election. I disagree with that a little bit. I think that there are a great many banks out there right now who are going to face some margin compression, at least in the short term. And that is because of the next thing we're going to talk about here. So accumulated other comprehensive income, AOCI. When a CFI changes hands, its balance sheet, including loan products and bond holdings, is marked to market. Adjustments can be substantial and have implications for regulatory capital ratios and profitability, as well as for CFI's ultimate selling price. What that basically means is, so say you have, I've talked a lot at the channel on things called unrealized losses in your bond portfolio. So if you have big losses in your bond portfolio, when you go to sell, you have to mark to market, meaning you are going to have to realize those losses. And depending on how big those losses are, they could have a very big impact on the ultimate sales price that you ultimately get. And if you have a combination where you have to sell this, and then you have the declining interest rates, which actually, if you're what's called negatively gapped on your balance sheet, and you experience margin compression, and you have to acknowledge losses in your investment portfolio to boot, that's really going to cramp on the potential price that you're going to be able to get. So, and now it goes on to say regulators. So the FDIC and the Federal Reserve take a keen interest in proposed bank M&A deals. Getting there, okay, can be a long, complicated process that puts risk management measures, capital sufficiency, financial stability, and competition under the microscope. Delays or rejections can botch a sale. So any CFI considering M&A needs to stay up to date in these and other areas. Doing so may increase your value to a potential purchaser, or might increase the amount they're willing to pay for another financial institution. Golden parachutes and similar agreements. Golden parachutes, money paid to outgoing executives at a purchased company, and other binding obligations around staffing or compensation can drive down a CFI's market price. They can, but they can also boost it up too. Like, in other words, if you're going to bring a couple of those executives onto your bank, maybe the CEO is going to, not be the CEO anymore, but maybe he's going to stick around as a board member. They could bring a lot of value to your institution, especially if you've got a lot of key lending personnel that they come over, they're going to, maintain those relationships that you're hoping to buy and procure and bring over to the bank, and obviously grow the assets of the bank. So those are not necessarily always a bad thing, but I see their point. I mean, if you have to pay out a ton of money to executives that are going to walk out the door, yeah, that could be an issue. But like I said, then the final thing that I would add to this is your vendor contracts. If the vendor contracts, especially for like your core provider, they could be very long. They could be 10-year contracts. Could be very expensive. They could be very expensive to get out of. You might have to, you pay penalties. These things could be in the hundreds of thousands of dollars. So that could be a potential issue as well. But all other things being equal, CFIs can maximize their value by seeking out strategic business combinations that leverage both sides' strengths and minimize their weaknesses to create mutual beneficial deals. Valuations may also increase when CFIs have strong assets, are up to date with regulatory requirements, and offer deal terms that minimally restrict a purchaser. So there you have it. So there's I think some really good factors there to think about in determining what the CFI's ultimate value is, and what what somebody's willing to pay for them, depending on these different factors as they come along. But overall, M&A, like I said, M&A market still remains kind of soft. Now that we're going to get a changeover in the regulatory regimes, we'll kind of see what that brings in the next year or two, in terms of, because one of the biggest things with M&A is how slow, these transactions have been taking, because the current regime in status running a lot of the regulatory agencies, was really, really hampering a lot of the M&A transaction business. So I would expect to see M&A really perk up as hopefully if regulators ease back, transactions are able to get done in a normal time frame, meaning probably within a 12-month period of time. I would expect you would start to see some merger activity pick up, and hopefully prices will continue to be okay, over the next year or so. But all right, well, that's all I've got for this episode today, everybody. I'll wrap up with this. Make sure to like, share, and subscribe, as that always helps the channel. Please leave your comments down below, as I love getting back to everybody. Make sure to check us out on YouTube, Rumble, and all major podcast platforms. Please check out some of the other content on the channel, as I have a lot of great stuff out there, and I will see everybody again real soon. Thanks a lot.